Today I'm talking about trusts, what they are, how they work, and why they're such an important tool for asset protection, tax planning, and estate management. But before I dive in, it's important to understand that this video is general information only. It's not financial advice specific to your circumstances. Trusts are complex, and getting the right advice for your situation is really vital. So please always speak to a qualified accountant or lawyer before making any decisions. We'll help you get started with the basics of understanding trusts today, but if you need a plan tailored for you, you can book a meeting with me through our website. Now let's get started. So, what is a trust? A trust is a legal arrangement where a person called the trustee holds assets for the benefit of others. These are called the beneficiaries. It's been around for centuries. It actually came from England during the Crusades, when knights would leave their property in the care of others while they were away. Today, a valid trust must have a trust deed that documents the rules of the trust and defines the people involved in the trust and their roles. The goal is to protect assets, manage wealth, and sometimes help with tax efficiency. And who are the key players in a trust? There are a few important people involved. First, we have the appointor. This is the most powerful role. It's usually the person who decided to form the trust. Whoever has the appointor role usually controls the trust. And next, the settlor is the person who evidences the creation of the trust. Their role ends after signing the trust deed and transferring a small initial asset, like $10. This person is usually your accountant, and their role is to see that the trust is correctly set up according to the terms of the trust deed. The settlor is forbidden from having any further role in the trust, but can continue to act as your accountant. And next, the trustee is the person or company that operates the trust. They must manage the trust responsibly and according to the trust deed and law. The appointer can sack and replace the trustee. And finally, we have the beneficiaries. These are the people who benefit from the trust. They're entitled to income or assets of the trust, depending on the terms of the trust deed. These are usually defined as the family members of the appointer. So what are the beneficiaries' rights? Beneficiaries are very important. A trust might hold assets like rental properties or a business that generates income. Before June 30th every year, the trustee must decide which beneficiaries will receive a share of the income of the trust. They prepare a trust distribution resolution. The beneficiaries are usually considered beneficially entitled to receive that distribution. In most trusts, if a beneficiary becomes absolutely entitled to income of the trust because the trustee has distributed income to them, they can demand their share at any time. For minor beneficiaries, that is, under 18, there are special rules. Once they reach adulthood, usually 18, they may access their entitlement if the trust deed allows it. Until then, a parent or guardian can often draw funds on their behalf for maintenance and education. Again, depending on terms laid out in the trust deed. Next, we'll look at the role of the trust deed. The trust deed is everything. It's the rule book for how the trust works. If the deed says the trustee must do something, they have to do it, even if they personally think something else would be better. Always read the trust deed carefully before making decisions. This is an example of some of the pages of a typical trust deed. Each supplier's deed looks a little different. I thought it might be helpful for you to see one example. The final page is often the execution page where everyone signs. And how trusts are taxed. Tax law treats trusts in a very particular way. Generally, the income of the trust is taxed in the hands of the beneficiaries. Trustees can be taxed themselves if they don't distribute correctly, or if minor beneficiaries are involved in a non-testamentary trust. Distributions to minors should be limited to a maximum taxable income of $416, as very high tax rates apply to distributions to children over this amount. If the trustee pays tax, it's usually at the highest individual tax rate, much higher than most beneficiaries would pay. Hence, the objective is usually to distribute all of the income of the trust. We usually prepared trust distribution minutes like this one, starting with specific dollars, then percentages, and finally the remainder, to be sure that everything is distributed. Careful tax planning is critical for trusts, and this is why you should always talk to a professional before the 30th of June each year. We had a case where a new client set up a family trust years before becoming our client, and the trust wasn't set up correctly. When their business ran into financial trouble, the trust deed left a hole in their asset protection strategy. Choosing the correct setup in the first place could have protected their assets properly. Trusts are powerful, but only if they're understood, set up, and maintained correctly. If you'd like to understand more about trusts, we've created a free downloadable guide that goes through everything you need to know in more detail, with plain English and no jargon. Head to our website to download your free copy. The link is in the description. And if you'd like personal advice, book a meeting with me and let's put together a plan tailored to your needs. See you again soon.